Hello and welcome to everyone to the very first lecture on the Introduction to Financial Econometrics. I hope I am excited to discuss. All of you are excited to go along with me to this journey to learn and discuss about the financial econometrics. So today we will discuss about what is financial econometrics and why we wanted to learn this course financial econometrics, how it is different than the term we have often heard, that is econometrics, and we will also discuss what are the broad topics we are going to discuss in this particular course. So what is financial econometrics? So before that, let's us discuss what is econometrics. I hope many of you know, if not everyone, know about this term econometrics. So this term econometrics is made of the two terms, that is econ and matrix. And the literal meaning of this term is measurement in economics. So basically the econometrics is an amalgam of the three different subjects, that is economics, mathematical methods and statistics, for the purpose to verify and measure the economic relationship. And we all hope you will be aware that in economics, when we put it into the mathematical form, that is basically a deterministic relationship we represent. Then we use the concept from the statistics and we have the randomness into the relationship of economic theory. Then what is the financial econometrics? Financial econometrics is basically a specialized branch of the econometrics that applies the same statistical methods and mathematical tools to analyze the financial data such as stock prices, market indices, interest rate, exchange rate, other portfolio uh, variables, the different aspects of the financial system. Primarily, this combines the finance, statistics, and economic theory to understand and predict the financial markets and financial instruments behavior. Then question arises, why we need a specialized branch of econometrics to deal with the financial data or to understand the behavior of the financial markets? Is the econometrics itself is not sufficient? Primarily, there are the two reasons we can cite. One, that the financial data for which we are going to discuss or for which we are going to learn the different techniques, it has certain unique characteristics which is little different than the other macroeconomic and economic variables for which usually we resort to the econometric tools. The second aspect is that we focus a different financial specific aspects when we talk about the financial econometrics. So let's go into the detail of the first part, that is the what are the unique characteristics of financial data we have. So the first is that financial data often show the fat tails and the extreme values. So that means the financial data often deviates from the normal distribution. Now if we recall in the econometrics or in general in modeling aspect, we do assume that the variance or is or the distribution of the data is the normal distribution, where we do assume that often we do assume mean and variance both are the constant. However, when we say the data is fat tails and extreme values, that means either it will be positively skewed or negatively skewed or could be both. And if that is the case, then it has huge implications for the participants or for the financial markets. That is that if there is the extreme value or fat tail data shows the fat tails, then there is the chances of having large fluctuations into the variables, let us say the stock prices. If there is the large fluctuations, then there could be either the large profit or there could be the large loss. So that is the extreme chances we have. The second property or characteristics of the financial data we have what is known as the volatility clustering. Basically, it shows the persistent volatility. Though in the course we have discussed in detail what is the volatility clustering, what we mean by this and what are the implications it has. In simple terms, we can understand this. If there is the large fluctuation in the data, then it will follow into the next period the large fluctuations. If there is a small fluctuation in the data, then it will followed by a small fluctuations. That's what we call the volatility clustering or the persistent of the volatility. When we have these two characteristics into the financial data, then the normal econometric models, structural models, where we do assume that the data follows the normal distribution, then we assume that the variance is, or the fluctuations or variability are the constant. And in such cases where we do have this kind of characteristics, implementing those models may be misleading. It may mislead us to us, or it may mask the true relationship of the or true behavior of the variables. Therefore, we need a specialized method or tools which we are going to discuss into this particular course. The third characteristic is that often the financial variables are of non-stationarity in nature. Again, there is the though there are the methods through which we could convert the non-stationary data into the stationarity. However, during this process, we may lose the certain informations or certain behavior of the data. The fourth unique characteristics of the financial data which often has been observed is the correlation structure among the variables. That means there is the interdependency among the variables we have. If that is the case, again, the models which do assume there is no autocorrelation, there is no correlation structure among the variables will not be appropriate to decipher or to analyze such model where we do have the correlation structures. Often we have heard the term the volatility spillover, or we have heard the word contagion effects. So these are the basically shows the correlation structure of the data. So if we have this kind of characteristics, we have to find out the certain different models, different tools which we are going to discuss into this particular course. The fifth unique characteristics we have, often the financial data will be available in the high frequency, where uh, when we say high frequency, the duration of period is very small. Nowadays, even we are able to capture tick by tick or transaction by transaction records or generate the data. So the financial data, we can say it is kind of a continuous variable. So in that case, then again, the pure econometric tools may not be appropriate, and we need a certain specialized tools and econometric methods, which is part of the financial econometrics. The second aspect that why we need a separate branch comes from the special focus of the financial aspects. Let us say here the risk management and volatility modeling. In most of the econometrics, we are concerned about the variable itself, or the return or the prices, or the mean structure of the process. We are not often concerned about the variance structure of the process or the data. However, in the finance, often and in fact most of the time, an important aspect is the variance structure of the series. For example, risk management, or what we call the volatility modeling, that emerges from there, that we are concerned about the variance dynamics, not the mean dynamics of the data. The second aspect is the testing financial theories and the market efficiency, which is quite often little intricate or have the complex than compared to the other macroeconomic theoretical relations we have. Third aspect here, that we are concerned about the asset pricing or the portfolio optimization, and again all these two aspects we are concerned very much with the volatility or the variance dynamics of the series. So if taking together these two concerns, we can infer that most of the time we will not be able to cope up, or we will not be able to appropriately justifiably use the econometric general economic tools in this scenario, in this context. So this context warrants that we need to have a specialized branch of econometrics, which is known as the financial econometrics. So in simple term, we can say the econometrics for the financial data, which has certain unique characteristics, and where the focus is specialized aspects of the finance. If we wanted to compare this financial econometrics and the general econometrics, and if you use the basis of domain of application, we can observe that in the financial econometrics, the focus is primarily on the financial markets, prices, and its instruments, or the financial system. Whereas in the general econometrics, the broad focus is on economic variables, the policy makings, the policy analysis. So there are the little different aspect domain of applications we have. Similarly, if we are concerned about the nature of data, in financial econometrics, often we deal with the high frequency data and a data with the volatile nature or the time varying characteristics, and often which shows the non-normal distribution. Whereas in the general econometrics, most of the time we deal with the low frequency data, for example, annual, quarterly, or at max monthly. And we have further broader scope for the general econometrics. If we wanted to talk in terms of core or the key and or the important techniques in the financial econometrics, for example, we have the volatility models, event studies, high frequency analysis, value at risk matrices, or we deal with the seasonality or intraday aspects of those techniques. However, in case of general econometrics, we deal with the cross-sectional data, panel data, even we deal with the time series data with the low frequency. We deal about the policy evaluations. However, in the recent, there have been development in the financial econometrics also, where we also deal with the panel data. However, it is compared to general econometrics, there is little less implications we have for the panel data in the financial econometrics. So what are the core topics we are going to discuss in the financial economy, or what is the core of the financial econometrics? See here, for example, we are dealing with the time series modeling. For example, ARIMA, GARCH, co-integration, those are the time series modelings. We deal with the vector autoregressions. So we also deal with the structural vector autoregressions, GARCH and its different variant, different extensions. Then the second aspect, we have the asset pricing models. For example, capital asset pricing model, pricing model, or the arbitrage price theory. So there are the certain pricing models we discuss. The third aspect is the portfolio optimization in the risk management. The portfolio optimization, when we say basically to minimize the risk in the financial markets, we do have the combination of different stocks into the one basket, uh, with the sole purpose of minimizing the risk and maximizing the return. So how to minimize that? How to select the different assets? How to track that the risk of those assets? And how to assess the relationship between risk and the return? So those are the key aspects we have in the financial econometrics. Then how we do realize, manage those risks. So that is the part of that. Then one of the core topic, we have the event study analysis. So here we do examine if there is a certain incident happen, whether it's positive or negative, how it is going to affect the financial markets, the different assets, different companies in terms of the financial aspects, in terms of growth. For example, if some company announces the dividend or earning, how it is going to have impact on the prices, asset prices of the particular company, how it is going to affect the financial health of that particular companies. So those are the things which we are going to discuss in the event study analysis. Then we also discuss the high frequency and the derivative data modelings. For example, the Black-Scholes pricing derivative pricing formula we use. For example, we use the realized volatility models, which is based on the high frequency data. We do also test the different financial theories into the financial econometrics. For example, we often have heard that efficient market hypothesis. So does the markets are efficient? If not, then what are the factors? What are the anomalies are there? Or what is the arbitrage price theory? Is it really do exist? So those are the core topics we have in the financial econometrics. Then what is the importance of the financial econometrics? One aspect is the risk management or the volatility. So when we say risk management, primarily we are concerned with the volatility modeling. So the risk management, this whole area of the volatility modeling, value at risk estimations, all those helps us to manage the risk. For example, suppose we have a portfolio and we wanted to assess the risk, we have to rely on the financial econometrics. So the financial econometrics helps us to measure the risk, to assess the risk, or to manage the risk. Similarly, asset pricing. So what should be the pricing of the asset, or whether the prices are normal or is it abnormal? Is it reflects the current, the real worth of the asset? What are the different pricing formulas we have? Is it valid? So is it satisfy the certain conditions? Those are basically we talk in terms of the asset pricing. And the financial econometrics helps us to verify or validate the different pricing models. Then the portfolio optimizations, the financial econometrics helps us to identify optimal asset allocation strategies. It helps us to identify the risk of that particular portfolio. Regulatory compliance. So financial econometrics also do help us for the regulatory compliance. For example, stress testing. What is stress testing? In stress testing, basically what we do, we see that or we assume that or simulate the situation where we do have the plausible adverse conditions, then how the financial assets or the financial companies or the finance of the company they do perform. So that's what we mean by the stress testing, and for the stress testing we need the financial econometrics. And through stress testing we do assess, for example, capital adequacy ratio. So using this financial econometrics, we do perform this stress testing on that, and then we assess whether it is regulatory compliant or is it not compliant. and it also helps us in the decision making. For example, whether it's investor, whether it's the borrower, for everyone it helps. Financial econometrics helps to make the decisions. Is it the right time to borrow from the market, or is it right time to invest into the market? So basically, uh, assessing the different conditions of the financial markets, we have to take the decisions. And to assess those various aspects of the financial markets, we rely on the financial econometrics. So the financial econometrics also helps us for the decision making. Decision making. The another application, if continuation with that, we can see the application of the financial econometrics in the forecasting financial variables. For example, prices, returns, volatility, we could do, forecast. Similarly, we can assess the market efficiency and its anomalies. To take any measure to correct the market, we have to first identify the problems. We have to first assess the market situations. So, to take any policy decisions, we have to assess the market efficiency anomalies, and the financial econometry helps to do that. Similarly, we can use the financial econometrics to evaluate the impact of the policy changes on the markets. For example, the monetary policy. So, if there is a change in the monetary policy, then how it is going to affect the financial markets, how it is going to affect the liquidity, how it is going to affect the different companies, different aspects of the financial markets. So, that can be done using the financial econometrics. Similarly, we can use the financial metrics for pricing the derivatives, understanding the market dynamics. For example, Black-Scholes formula we can use to understand the price derivatives, and for that we need the volatility, and we do have the different models to forecast to measure the volatility of any assets. Similarly, we can use the uh, financial econometrics to measure and manage the risk in portfolios. So, these are the broad aspect we have the financial econometrics. However, here we have discussed the very specific uses and applications of financial econometrics into the finance. Then one question we may think of, the financial market in terms of the quantum of the GDP of the economy, or in terms of the participation of the people in uh, of the economy, is very less, then why we should have such concern? Basically, this discourse is misplaced. We may recall the global financial crisis of 2006-7 or the 7-8, where we have seen that the whole world suffer because of the miscalculation of risk, miscalculation of strategy, miscalculation of forecast started with the financial markets. So, the financial markets, the effect of that, the interaction of that is not limited to the financial market. It has the huge and the implication for a whole of the economy. For example, we know that for the growth we need the finance, and often for the finance, where we do go to the financial markets or the banking stream. Both do have the implication of risks, and this capital what we need, often which we go to the financial markets, that can perform better, that we can optimally use only when the financial markets efficiently work. And to work efficiently, we have to have the measurement, assessment. We have to understand the dynamics and behavior of the financial markets. And this financial econometrics do help us to analyze, to understand, to find the patterns or the different characteristics of financial system. So it's a very important course, whether you are the macroeconomics aspect you are looking, whether you are looking at the macroeconomic aspect, whether you are looking from the international aspect into the economy. This plays a very important role into that system. So hopefully every one of you will be continuing this course and you will join me to this journey to complete this course. Now, what will be the structure? What will be the roadmap of this course? First, this course here has been designed in such a way that we gain the knowledge of both theoretical framework as well as the practical implementations. So, most of the weeks we have 4 classes or the 4 lectures or the 4 discussions on the theoretical framework, and the one day we have the implementation of those theoretical framework into the real world data using the statistical software R. Here knowingly I have choose R because it is free and it's easy to learn and it can be used as the a scalable at the large scale level also. So this course is blends of both theoretical structure, theoretical framework and also with the practical implementations, so that we can have a comprehensive skills, tools, knowledge to understand the financial markets better. So this course has been divided into 12 weeks. In the first week, we'll discuss about the introduction to financial econometrics, which basically we have done today itself. Then it is followed by the introduction to the financial system, financial markets and various instruments. Then in the second week, we do discuss about the financial variables, different concepts related with financial variables. For example, the price based variables or the volume based variables. Then we also do discuss about the time value of money, certain aspect of the fixed income securities. Then followed by the week 3 and week 4, where basically we discuss the linear regression models, which is basically the backbone of any econometrics course. So here we have tried to briefly discuss that because our purpose is not that linear regression model, rather than we have the financial econometrics is the core. However, I have designed this course in such a way that if you have not studied even before this econometrics, you will be able to understand. So in the third week, we have discussed linear regression models, its different assumptions, its estimations, its properties, and violation of certain assumptions. In the week 4, we have continued with the violation of assumptions, and we have also discussed about the simultaneous equations model. Then in week 5th, we have talked about what is time series analysis and the concept of non-stationarity and stationarity. What is the implications of non-stationary data? How we test the non-stationarity of a particular data? Is there any way to change non-stationary data into the stationary data? So those various aspects we have discussed in the week 5th. In week 6, then we have discussed about the univariate time series modeling approach. So where basically we need only one series, and using that past observation of that particular series, we do try to understand the behavior of that and the characteristics and the dynamics of the particular series. In that we have discussed about the autoregressive model, moving average model, combination of these two, what we call ARMA in short, or autoregressive and moving average models. We do have also discussed the ARIMA model, that is autoregressive integrated moving average process. Then we have also we have tried to implement those various theoretical structure using the R. In week 7, we have taken the route to us to the multivariate time series modeling, because we know that in often in financial econometrics and in general also in this integrated world, as we have similarly there is the integration and the interdependencies among the financial as well as the economic variables also. So in such cases we need the multivariate form. So we have discussed about the multivariate time series modeling, where we have discussed the vector autoregression, and we have also discussed the structural vector autoregression and the vector correction models, configuration. We have also discussed about the causality. In we have discussed week 8 and week 9, we have discussed the various aspects of the asset pricing models and the different asset pricing models we have discussed. In week 10 and 11, we have discussed about the volatility models, where we do see if we are assuming the constant variance, then what implications we have, or how we can reformulate, restructure, or have the different models which could consider that no, the variance is not constant, volatility is not constant, which is the quite observable fact of the financial data we have. Then at the last, in week 12, what we have discussed about the event study analysis. As I have discussed in the beginning of this lecture, that event study analysis, basically we try to assess the implications of the certain events, whether it is positive or negative, whether it's pandemic COVID-19, or whether it's the assistance announcement by the IMF, or any government or the central bank of for a particular sector. So how do this financial variable, financial assets to react those news? Then we have also discussed the value at risk in the 12th week. In every week except the first 2 weeks, we have tried to implement these theoretical structures through the R and see how we can interpret and assess those various models. So this is the broad roadmap we will follow in this particular course. I am hoping and I am also assuring you that throughout the course of this course you will enjoy, and at the end of this course you will have certain skills, certain knowledge about the different tools and techniques to be used to analyze the financial markets, to assess the dynamics of the financial market, and to have a broad understanding of this financial market or overall financial system. So I hope that all of you will enjoy and all of you will follow this course and complete this course. So thank you very much for joining this course. So in the next class, we will discuss about the financial systems. See you in that class.